Good morning, everybody. Today we are talking about chapter 17 and we are on handout number 9, chapter 7, not 17. And we're on handout number 9. If you were here yesterday or Tuesday, you got a handout. If you were not here, I have a few extra copies, so just give me a wave if you need one. Also, if you have your in-class group work for chapter 6, if you could bring that up to me if you didn't turn it in already. If you emailed it to me, I got it. Other than that, you could have submitted it online as well. Thank you. Are there answers on both sheets now? Okay. Okay.
We have those, which would be okay if you like.
Yeah. You email, yeah, you email, you're good. Okay, so in chapter 7, we're talking about internal controls and cash. And I put this picture up because it comes out of your book. And it's pretty hysterical, right? So according to your book, we just create some internal controls that are effective and there's no more fraud and theft ever, right? Well, what happened in 2008? We had the housing crisis and it was facilitated because companies hid their risk, right? They bundled mortgages together that would normally have considerable risk if the economy was to go into a downturn, and they graded them as high quality investments. And so what happened was those investments failed. The economy started to go down and those investments failed. And so we had the housing crisis. Now, weak internal controls will result in fraud and theft. If you give people the opportunity, they will steal from you, they will commit fraud. But effective internal controls don't guarantee that there will be no fraud or no theft. There are ways to get around even effective internal controls. The most common way is collusion, and that is people working together in different parts. Generally speaking, your internal controls want to protect your assets, make sure that the financial reporting of your transactions are good, and to reduce opportunities for fraud and theft. And so that's what internal controls are about. So in a job, when you get a job for a big company, they should provide you with a procedure manual, and you should be able to follow those procedures for your position. And those are part of the internal controls. So we'll talk about some of them. We'll do some examples. And if you have any questions, please let me know. All right. So the purpose. Internal control is defined as the procedures and processes used by a company to safeguard its assets. Sure. Oh, by the way, I accidentally put part 2 on this. There's only one part for the chapter 7 notes. It's a relatively short chapter. Also, while I'm thinking about it, next Thursday, no in-person class, no online class. I will hold the chapter 7 and chapter 8 In classwork for you to do at home in your convenience over the weekend. It'll be due on Tuesday, the 29th. I sent out an announcement, so just confirming that with you now. All right. Sorry about that. All right. So safeguard its assets, process information accurately, and ensure compliance with laws and regulations. Absolutely. You're right there. We had an actual. Hey, Sarbanes-Oxley requires companies to maintain effective internal controls over recording transactions and preparing financial statements. So probably before most of you were born, back in the late 2000s, companies were excited because they started to loosen up regulations and they started to be able to pay their executives with stock. And that resulted in huge compensation, but it also resulted in the manipulation of that stock price. And how they did it was with gray areas in accounting or just out and outright fraud that they were able to hide. So you had WorldCom. WorldCom was a communications company. And in the communications industry, everybody would expense a telephone pole. And you say, well, you know, how much does it cost to put it in a telephone pole? Let's just say it's $2,000. Well, how many telephone poles do you think they put in each year? Millions. So it could be millions of dollars that they're having to replace every year. And so what they did was they capitalized those costs. So another business like ACCT, let's say, that was competing with them would have this expense of, let's say, $60 million. Whereas WorldCom would only have an expense of $5 million. Now the scale's not right there, but you get the idea. And as a result, their stock looked great, their expenses were low, but it came to me that it found out that that's what they were doing. It was different than industry standards, and they suffered a loss, ultimately their stock decreasing so much and then merging with another company to try to save the company. There was also Enron. Enron took advantage of what are called special purpose entities. These are ventures that you can do off the books with, as long as you provide kind of coverage of assets and liabilities. And what they were doing was they were using their own stock to prop up their assets and liabilities. So what happened is because their own stock was being used as an asset when their stock price declined, they didn't have the money to cover those losses now that they had the liabilities out there. And there was some irregular accounting as well. There's a movie called Smartest Men in the Room. It's about the Enron scandal and the culture of the company, and it was basically make money at any cost. I think we've all seen, you know, The Wolf of Wall Street or something like that. This was kind of that time, and it was show me the money, make money however you can, pump and dump stocks. And so that was the attitude that was there. And so Sarbanes-Oxley are, I believe, 2 House members at the time in early 2000s. And they basically said, listen, our financial system relies on accounting reports. If you guys aren't putting out accounting reports that matter, you can literally hurt the global economy by hurting the US economy. When you talk about how much these companies when they had accounting scandals lost back in the 2000s was 90 billion. AOL had a drop of $100 billion. So we're talking about huge, huge dollars and investors being totally wiped out, especially at Enron, because a lot of the investors were their employees. They used to put stock in their retirement plans instead of cash. So they kept their cash for the job, but then they put their stock in. And so employees thought, hey, I've got $1 million when the stock's doing great. Well, what happens when the stock crashes? How much is the stock worth for a bankrupt company? Nothing. Exactly. Stockholders bear all of the risk and almost none of the ability to recoup their claims once a company goes bankrupt. They're last in line to get anything. And by then, Enron was a complete and total waste. And a lot of these people lost, you know, I shouldn't say billions, but there were billions of dollars lost spread out equally. Now, if you think about it, who's the biggest holder of stocks? Now, they say mostly the wealthy own most of the stocks, but we also own it as well because there's been a shift in risk for pension plans to defined contribution plans. So back in the 70s, 80s, I would say up until about the 90s, a lot of companies provided pension plans. Well, a pension plan means that company's on the risk to pay you X amount of dollars once you retire. So that's expensive, and it also shows up as a liability on their books. So they decided, let's go to a defined contribution plan. So you probably know it as a 401k. All right, so if you go and apply in a company and they say they have a 401k, usually that means you can put some money towards your retirement subject to legal agreements, and then your employer may or may not contribute some on top of that. But that risk for how you invest that money is all borne by you. The company, once they put their contribution in, doesn't have anything to do with how that money turns out in retirement. So normal people that did not in prior years have real funds in the stock market now do, because pension plans, mutual funds, index funds are all things that we invest in with our retirement funds. And so they get put into these plans. And as a result, we now are big shareholders in a lot of these companies. Now, we're not going to go in and get to vote for them, but the company that's holding our shares, I use TIAA-CREF. You might have heard of Fidelity. There are several other companies that manage your assets, and usually you put them into a mutual fund that's kind of safe. But all of that has shifted now to us. We're responsible for our own retirement plans. So this is an important change, because when this all happened, guess what all the executives said? People that were supposed to be experts, CFOs, COOs, CEOs. Guess what they said when they had to testify their day in court? It's the same thing you all are saying now. What are you guys saying right now? I don't know. That's exactly it. For once, you guys were dead on. I don't know. The CFOs and the CEOs and the COOs said, I don't know what's going on. I'm just here at the top of the company. I've got these people working for me. If they did something that was bad, wasn't my fault. And some of them actually got away with it. And guess who served jail time? Yes, exactly. The accountants at the lower level who sometimes didn't even know what they were doing, right? They just said, hey, move this money to this fund or move these assets to this fund, report this way. And that's what they did. And so there was no requirement that a CFO or a CEO knew what was going on in their company. So unless the police could come in and find a trace of these leaders knowing what was going on, then they often walked. Jeffrey Fastow was the CFO of Enron. One year they gave him an award for his accounting. The next year they threw him in jail. And so when he comes out and does a presentation, he puts his award up there, CFO of the year, and then he puts his inmate number right next to it. And he was doing something that was shady, but in good times, nobody noticed. But when bad times hit, then all the shady stuff came to light. And so he got prosecuted. Well, Sarbanes-Oxley comes along, and it's written by, I believe, like I said, 2 House members. And what they said was, hey, you guys are now going to have to sign off on your financial statements. And you are going to certify that you have internal controls that safeguard your assets, process information accurately, and ensures that you're complying with laws and regulations. And this is throughout the organization. So immediately, companies all went, wah, because they had to spend, in most cases, $50 million to upgrade their systems to start doing this so that they could account for all of this. Not only that, but their internal audit team, this is a group within the company that performs audits. And it's slightly different than external auditors in that they also do operations, but they work for the company and they report to the audit committee. And so they come in and they do these audits based on how the controls are set up to make sure the controls are functioning properly. So you need that one layer, and then the CFO and the CEO sign off on it. So now they are legally responsible for A, knowing what's going on and knowing things are going right. And so they can be held accountable. Now, have any CEOs or CFOs been held accountable since then? Probably. But were the CFOs and CEOs held accountable for those big banking things? Nah. Right? We all potentially lost billions of dollars collectively on the values of our homes because they let a small group overinflate their assets, overinflate their earnings, and be unable in an economic downturn to cover their homes. And so all the homes lost value. So Sarbanes-Oxley comes in and says, nope, can't do that. Going to be responsible, going to be liable now, and you're going to have a better framework. So when you get there to a job and you have your list of duties, your duties should be separate from the things that you do. If you are an accountant, you should not have your hands on the cash because you have the records. So you could take the cash and wipe it off the records. If you are in operations, you shouldn't be able to handle the paperwork and then also handle the cash or handle the accounting. So separation of duties is the main way to do it. But if you collude with other people, it can still break these controls. So how do we safeguard assets? What do internal controls do? They prevent theft, fraud, and misuse or misplacement of assets. Processing information accurately. This means that your financial statements are reasonable and reflect the economic activity of the company. Investors can rely on the information to be reasonably accurate. And I say reasonably, And when I say investors here, these are professional investors that are going to do the analysis on the financial statements. Reasonably means materially, right? Things that go on at Walmart are not going to be the same thing that could go on at Cash Savers. If Cash Savers had somebody come in and steal $10 million, it would be a huge deal. If Walmart loses $10 million, it's not as big a deal unless their internal controls fail. And then, of course, it's straightforward, but you want to make sure that you ensure compliance with laws and regulations. And this includes both providing the correct information to regulators, but also following laws in the operations of the business. Any questions so far? Okay, let's talk about what is the control environment. The control environment is the overall attitude of management about the importance of controls. There are three main factors identified by the authors that influence a company's control environment. The first is management's philosophy and operating style. And you'll sometimes hear this called the tone at the top. And the question that you want to ask is management's emphasis on controls or operating within the control environment, or are they focused on operational goals regardless of the control environment? So what is management talking to you about in the interview process? What are they telling investors? What are they telling things that come out of their corporate relations? Are they saying, listen, we're going to hit our earnings per share at all costs? When you come in, you're going to work hard for us and we're going to achieve these goals? Or are they telling you that, you know, we expect you to operate within our system and still achieve your goals? Enron is a perfect example of a company that said, just find a way. Just find a way to hit our profit goals. Just find a way to hit our revenue goals. And so the company would shut down power plants. They decided that they wanted to buy power plants or invest in power plants, and they would shut some of them down at peak times, arguing that they needed to do maintenance or something like that. And being from Texas, what happens when some power plants go down? What happened a couple of years ago here during the winter when the power plant shut down? Most of the grid shut down, but the people who still had electricity, what do they have to do? Yeah, they had to pay an unreasonable amount of money. And what was happening in the early 2000s was deregulation. And everybody was deregulating everything so they could take advantage of it. There were no rules against them shutting down a power plant and jacking up the prices. So that's the type of thing that they would do. So if you walk into a company and you can see that they're only talking about their goals, they're not talking about operating within the laws and the framework, then you know that there's some real risk there. And so what management says matters. If someone's screaming at the top, show me the money, and doesn't care about burning investors, then you know that company is going to ask you to do some unethical stuff. All right, so management has to have a tone at the top. They respect the controls, that people need to operate within the control environment. All right, the company's organizational structure. So this provides the framework for, bless you, planning and control. Is the structure appropriate to manage the employees and operations? We all like the idea of having a boss and having our own anonymity, but you've got to make sure that the company's organizational structure promotes controls, it promotes operating within a reasonable framework. And then the personnel policies. So does the company have policies that ensure that hiring, training, evaluation, compensation, and promotion are based on providing assurance that only competent employees, competent and honest, are hired and retained. Take your time and get those down. I'll give you a few minutes. Okay, looks like everybody's pens are almost there. Risk assessment is the next category, and basically they want to know that management has identified risks associated with their business, analyzed their significance, and then taken steps to minimize risks. Some examples include changes in customer requirements, competitive threats, regulatory requirements, and economic factors. When I was a public accountant, it was during the time where all this was blowing up. And it was a terrible time to be a new employee because Arthur Andersen was part of the big 5 accounting and auditing firms. And they went out of business as a result of a law case that was brought, or a case that was brought against them because of Enron. And one of the partners had the employees shred some documents, which resulted in a charge from the Department of Justice. Well, if you're an auditor and you get charged by the Department of Justice for wrongdoing, it really does call into question your ability to provide assurance services, which is what public accountants do. So they lost their reputation, and as a result, were basically wiped out. All of their companies said, we're not going to do business with you anymore. We're going to go to the other ones. And then there were big 4. Well, a lot of the employees didn't stay in public accounting, and so we all got overworked, the rest of us at the big firms, because for the most part, big companies need big firms to audit them if they're going to do it appropriately. And so we worked a ton of hours. We had to integrate a new audit, because not only now, before the audit was, we just go out and look at your financials and we have reasonable assurance that your financials are accurate. Well, now comes along Sarbanes Oxley. They create a group called the Public Company Accounting Oversight Board, which you would find out more in your auditing class if you go on to it. And they say, you've got to ramp up your audit requirements. You have to audit these internal controls, provide an opinion on those internal controls, and then provide an opinion on the financial statements. So now the auditors have to do almost twice as much work initially in understanding the controls, probably 5 times as much work initially, and then going forward twice as much work. So we didn't have the people, but we had to do the job. And so we worked a lot, and it was really challenging. But the first thing that we ask for in an audit is we ask for management's risk assessment. What are your risks to your business? Do you know who your competitors are? Do you know how your pricing is? Do you know your market share? Do you have a plan to keep that market share, maintain that market share? Do you know who your suppliers are? Do you know how to make sure that your suppliers are on the up and up and can provide you enough supplies for your business? Do you know who your employees are? Do you have controls in place to make sure that your employees aren't robbing from you, that they're productive and efficient, right? So there are ton of risks that management has to analyze. And we all know that even though Sarbanes-Oxley said you have to do this, that there still were failures, right? So we can put all the rules in place that we want, but it's not going to guarantee that we never have any theft and that we never have any fraud. And trying to say what the book said, oh, that fraud and theft is going to completely go away, is always something I go, not real comfortable with that. You have to know that this reduces it, doesn't prevent it. What are some of the control procedures that need to happen to provide reasonable assurance in preventing fraud? And so some of those procedures are competent personnel, rotating duties, and mandatory vacations. So let's talk about competent personnel, rotating duties. Competent personnel. Now, we've all heard about people that got hired for jobs that they were in over their head, right? This was a common thing for smaller companies, startups, things like that in accounting back early on, because they weren't as much worried about making sure that you were competent, even though the rules say if you're a CPA or a certified management accountant, that you should only accept jobs that you're competent to do. The rules were less stringent on the ethics, and so those people would often take jobs that they were in over their head. Well, if you're in over your head, what are some of the problems that can occur? Now, this is another great one, because you all don't know, right? And that's the thing about being not competent. You don't know what could be happening. So fraud could be happening right under your nose. Somebody could be telling you to do something that is not illegal, or excuse me, that is illegal, and you don't know it. So you need competent people. Why do we rotate duties? Bless you. Right. If I'm doing a job and I'm the only person doing that job, then the potential is there for me to be sneaky or to be nefarious about that job. So if we rotate the duties, then somebody else comes in and says, listen, I've got to follow what this person was doing, or they don't follow what that person is doing, and you get a whole different set of results, right? And so you go back and you say, why are things good now, but there was a problem before? And so comparing what's going on allows you to say there was a problem here. So that's part of it. Mandatory vacations is similar to rotating duties, right? Because if you take a vacation, somebody else has to usually fill in for you, do some of the things that you do. It gives them opportunities to see if you are not being on the up and up, or even sometimes it's just if you're making a mistake. So I'll give you a little history for me. I worked for a small chicken processing company that had a plant in Alabama. And so they would get the dead birds and they would process them into breasts. And sometimes the bone would have, sometimes they would have bone in and sometimes they would have bone out. And then they would send them to our company, and our company would make the products that you see in grocery stores. So if it was chicken tenders, We'd cut them into to the appropriate size, bread them, and send them out. Well, I worked in an office and there were only 3 of us. And our payroll person was out. And so I filled in on her job. And she used to do everything manually. And I decided to put it into a spreadsheet. And so I put it into a spreadsheet so that she could automate everything. And it turned out that she was actually making a mistake and she was overpaying the employees. Now, it was not anything she was doing intentionally, and she was doing it evenly. So it wasn't like I'm doing this to one person and then collecting some of that money, right? She just made a mistake. And so by having me come in there, I fixed the spreadsheet, and going forward, the people were paid appropriately. So small things like that can help prevent mistakes and also fraud and theft. Separating responsibilities for related operations. Again, the more people that you have doing things, the more people that are responsible, the less likely you are to run into fraud and theft and errors, because you have people checking and double checking. Now, again, it doesn't guarantee it, because humans are what? Fallible. We're bad at stuff. Our brains tell us, let's take a shortcut, right? We want to not process things as much as possible. We want to make our lives as easy as possible, but we're also not designed to stand there for 15 hours and do the same thing over and over again. And so by separating those responsibilities, you help improve the operations, you help improve the accounting, you help improve the control procedures. And then you also want to separate operations from custody of assets and from accounting. Now, most of you have probably worked a basic job, whether it was fast food. I know cashier is usually part of it, those kind of entry-level jobs. And the way it worked for me when I was a cashier was they gave me a drawer, and the drawer had X amount of dollars. And so what's the first thing you do when you get your drawer? You count it, right? Just like on the chapter, I think it was chapter 5 in class group work, I told you always check my numbers. I put a wrong number in there on purpose. If you found it, I gave you 4 extra points. All right. So just like when you get a register, when you get a drawer, when you have something that you're going to be responsible for, count it. All right. Always make sure you are where they say they are. So once I went through the day, I was on an electronic system. I know it's hard to believe when I was a kid, right? They had computers back then. Yeah, I drove my dinosaur to work. And I would get a receipt and it says, okay, this is how much you took in credit cards. This is how much you took in checks. And I would have to check all the checks and make sure I had all of them. And then they would say, you should have this much cash in your drawer. And I would count it. And hopefully it confirms. One day I was off $6.56. Turns out I forgot to charge somebody for a book of stamps. So that was as bad as I ever was on my performance. But otherwise, I was pretty good. And then once you would confirm it, you hand it to the cashier's office. The cashier's office does what? They count it again, right? There's somebody else. They're not involved. They count it again. The cashier's office then takes that and sends the deposit. Well, if there's a discrepancy, they send it to your boss and they have you come in and you count it And so you go through it and you figure it out. And that's how I figured out that I had a book of stamps that was missing. So that's one of the processes. Now they take it and they put the cash in the deposit bag, and Wells Fargo or one of the other companies would come and pick it up because it was too much money to have somebody take to the bank to be reliable on, right? Big grocery store could do $1 million in a day on certain days. So don't want them carrying that much cash. Have Wells Fargo come and pick it up a couple times a day. They are not accounting, but they put the first record of it in the accounting system. So now that receipt goes to accounting. And then in accounting, they record the receipt for the deposit. And then when the deposit comes back from the bank, they check and make sure it matches. So you have all these series of checks and balances, and you have separation of duties. Accountants don't touch the assets. Operations people don't touch the books. All right? And then the last thing would be proofs and security measures. And proofs are paperwork, trails, for example. One of the proofs when you receive documents would be a receiving document. So the proof of receiving a shipment would be the shipping documents. From receiving. So in accounting, if you are in accounts payable, you get invoices from your vendors, from your suppliers. And so usually you get those invoices before you're supposed to pay them. And so what do? You put those invoices into a file folder, and you make a little spreadsheet and you say, okay, I got this invoice. When are you going to pay that invoice? When you find proof that it was delivered. So each day receiving comes up and they hand you the receiving documents and you match them to the invoices. And then when you get the appropriate invoice, you put it in the computer to be paid. Now, most of the time in small companies, the accounts payable person prints out the checks. But a lot of larger companies are now going to electronic funds transfers and a separate check printing service, or a different department prints out the checks. But if you have a small company, you might not have the ability to do that. So once they print out checks, you make sure that they don't have access to sign those checks. So then it would go to a controller or a supervisor. They look at the work that they've done, and then they stamp the checks, and the checks go out. Or the electronic funds transfer goes out. So you have proofs that the material is delivered, that they were a legitimate business, and that they should be paid. Monitoring. So monitoring includes observing the operations and employee behavior for indicators of control problem. Use the information in the accounting system to detect anomalies and areas of concern. So we did this kind of a little bit, not in the I think it was chapter 5's analysis, I had you do a little breakdown and an analysis. And some of you said, we got to focus on profit, or we got to focus on lowering expenses. Well, I don't want to say duh, but duh, right? When you have an analysis, the analysis focuses on the specific areas, because management probably doesn't have time to go everywhere and fix everything. But our systems will tell us, hey, your sales are down, your expenses are up. You should go look and see why these things are happening. So who is paying attention to those reports? Now, we haven't talked about managerial accounting, but this is where managerial accounting comes in, and this is the internal controls report. So if you sit down with the director of sales and you say, how do you know that these sales that were made were good? And so hopefully that person tells you, hey, I look at those weekly sales reports. If I see something that's out of scope or unrealistic, whether it's gross margins not right, sales are too big, then I go and I look at it and you say, okay, show me that you've done that. And so what you want to do is you want to see that either that person has gone into the computer and checked off the sales, or that in their file cabinet, they have a sales report and it says follow up on this, and you can see what they did. So it's important to leave a trail to do these things, to make sure it shows evidence that you're actually doing them. Information and communication. You want to see that management is using information and communication about the control environment, risk assessment, control procedures, and monitoring to guide operations and ensure compliance with legal and regulatory requirements. So how do we communicate that we're doing all of these things? How do we communicate that we're improving, that we're changing, that we're monitoring, that we're doing all of these things? And the way that they do it is they look at the information and communications. I'm going to leave that up for another minute, just so everybody can get it all down. And remember, if you don't get it all down, there's a spot, just put a little asterisk next to it. I always post these on the website after class, so these will be there for you. Okay, excellent. All right, so we talked about that we're only able to provide some reasonable assurance. We're not going to be able to prevent all fraud and all theft, but we're hoping that we catch the majority of it so it doesn't become a material issue and it doesn't hurt our regulatory requirements, it doesn't hurt our assets, and it doesn't hurt our financial reporting. But we can only do reasonable assurance, and we talked about this, the human effect. We're humans, we make mistakes, it's what we do. Now, I don't talk about politics in the class, so I'm not judging one side or the other, but let's talk about what's going on in Georgia. Georgia just put out a rule roughly a month, less than a month before the election, that all ballots should be hand counted. How do we feel about that without thinking about the politics? Just hand versus computer. Let's not think about the politics. Hand versus computer. Who in general makes more mistakes? Humans do, right? Humans make a lot more mistakes. We get fatigued. When we have to do things in a hurry, we do not keep the same processes. So this could potentially be a huge problem because we rely on automation to test and to retest. Should there also be oversight of those computers? Absolutely. Should they be secure? Should they be protected? Should they make sure that they follow all the laws and regulations? Yes. But generally speaking, computers are much better at these menial tasks than humans. We stink at stuff, so we make mistakes. So some of our controls are going to fail. We think we did something, we didn't, we had a rough day, something along that lines. And then the other thing is cost benefit considerations. Now, you've probably gone into a Walgreens or a CVS, and I'm not calling these companies out because they're different, because they're not different than anyone else. But if you want to buy razors, what do you need to do in those places? Most of the time. I can't ask Ben, he doesn't know. You got to go find somebody, right? Razors tend to be a little bit more expensive. And so you got to find somebody that can unlock a cabinet. Now, does that prevent the vast majority of stealing? It prevents the petty stealing, not the big stuff where somebody got into one of your trucks at a truck stop and drove it away, but it does prevent a lot of the small petty. But what does it also do? Right, it makes people less likely to go to your store because they know if they're honest, they know that they're not the problem. And so they're not going to shop somewhere where they think somebody's watching them all the time. Somebody thinks as soon as they go in there that you're going to steal from them, and somewhere where they're going to have to spend a lot of time waiting around for somebody to come unlock a cabinet because you need $15 razors. Come on, right? So the cost benefit, we can make everything like Fort Knox, but the cost of that is immeasurable. And so we can't do everything. So we try to do and say, what is the cost of this? How is it related to our business? How can we minimize the risk in a cost benefit way? All right. And accounting is all about that in almost everything that we do. You can have a crazy accounting regulatory environment where everything we know is 100% certain, but it probably costs as much as the business makes to do that type of assurance. So we can't do that. Any questions on talking about controls? Any questions about Sarbanes-Oxley? Okay. All right, so now we're moving into learning objective 2. And we're talking about internal controls for cash. Now, it used to be the most important thing that you could do was you could reconcile your bank account on a monthly basis. We know now that bank accounts are updated much more often, and we have online access, electronic access to them. So while the bank accounts are still very important, hopefully they've got some type of system monitoring their cash accounts on a daily basis nowadays versus the past when you didn't know what was happening. You'll find out you got a balance in your book, but some transactions happened at the bank that you didn't know about. And so you've got to learn about those after you get the bank statement. But that doesn't happen as much anymore because you can just look at your account and say, oh, hey, what happened? All right, so why are controls over cash emphasized? We're not talking about controls over everything else. And the reason is because cash is easily stolen and difficult to recoup. OP. It is the asset most stolen from companies. Small businesses now protect their cash by using a register. And so with a lot of small businesses, when you go in there and there's only one employee, you might see a little sign at the counter that says, hey, if we don't give you a receipt, your purchase is what? What's that? So you do have the ones that are final. Those are slightly different. Sometimes you'll see that your purchase is free or you get 50% off your next purchase. What's the control in that case? What are they trying to control? So you work at a sub shop. You don't give somebody a receipt. What might you be doing? You might be stealing cash, right? If I don't have a record of that sale, then I don't know that you stole the cash. If you're working as an employee and somebody hands you $10 and you just hit the non-cash tender and the drawer opens up and you give them $4 back, you could take the $6 and put it in your pocket if you never rang it up in the register and nobody knows about that. So having customers be your type of control is one way. The other thing that companies do now is what? What happens when you buy something from a company? They ask you for a phone number or an email address, right? What are they going to do after you buy something? They're going to email you, they're going to text you, they're going to call you. Now, that first contact is not going to be sales. That first contact is going to be, how did we do? Right? And that's a control over what's going on at their job. You are serving as sort of an auditor. You know, if you went in there and said, listen, I gave them $20 and they didn't give me my change back, you know, then they know something's going on. You know, if it happens over and over again, or the food quality is low, everybody wants to know what's going on. And at the end of this semester, what are you going to get from me? A survey, right? They want to make sure that I'm in the classroom, that I'm talking with you, that they think that you think what I'm doing is fair. So you guys serve as an effective control to prevent bad teachers, right? So all this stuff kind of plays into that environment. Now, what is cash? And let me make sure I get this definition correct. It includes currency, coin, checks, and money orders. When the book doesn't note this because it's also part of it, but also include petty cash. Even though that's just cash, it's just a little fund. If you're running a business, you might have a couple $100 let's say you're running a plumbing business and you've got $200,000 worth of parts in your warehouse, but you got somebody 45 minutes from your warehouse that needs a part that's 15 bucks at the local hardware store. You want them to drive back to the place, get the part, and go back out there, wasting an hour and a half of their time? No, you tell them, go to the hardware store, get the $15 part, and when you come back, bring the receipt and I'll pay you out of the petty cash fund for it. So that's what it's about. You just have a small amount for kind of the needs of the day or the week. Currency, coin, checks, and money orders. And then one of the handy things they say is that you can think of cash as anything that a bank would accept for deposit in your account. There's no D in accept. You can't make stuff up. Sometimes you'll hear the term called cash equivalents. Are not cash, but can be converted to cash within 90 days. And that 90 days is approximate. And so what might that be? A certificate of deposit. You would consider that like a cash equivalent if it's going to mature within the, and sometimes companies will use up to 6 months, but usually within 90 days, you can consider that cash equivalents. So that's what you'll see on their financial statements. Okay. What are effective controls over cash? And cash must be controlled from when it is received until deposited in the bank. There are two primary sources of cash. Customers purchasing products or services. Customers making payments on account. And I'm going to go ahead and start here on Tuesday, 10-22-24. Please take your time to get the rest of that written down if you have any questions. I apologize about talking and hearing me talk for a whole hour and 15 minutes. It's not the way that I like to do this, but I want to make sure that you understand these concepts. And I think it's worth talking about them. Plus, I have an ethics presentation next Friday, and you can see that weaving this stuff in controls with ethics is a great way for me to think about it. So I appreciate you guys. And I will see you Tuesday. Have a great weekend. Now, I haven't told you before, and I won't call anybody out, but these type of shreds drive me bonkers. Thank you. I do, but I have to run to my office real quick. You just need the ones for chapter 6? Okay, you can set that on there. I'll be right back. I just got to grab something for Victoria. Thank you.
I was laughing earlier. You said something about 2008, and she kind of whispers, and I whispered, "I just graduated college."
It's nice to have somebody here in my own age demographic. Take care. So I wasn't sure if you needed part 1 or part 2. I printed both of them. Okay, thank you. Is that for Rhett? Leo, okay. Yep. Is he one of our soccer players? Okay. Is he's the one that sits here, not the one that sits next to you, right? Okay. Trying to get everybody's name, but the soccer players just don't come enough. And I know it's not their fault. It's soccer season, so hopefully it's for good reasons. You're welcome.